Hi there fellow traders, it's JCKriek here, and I thought I'd share with you a very interesting concept. And basically you need to start acting like a professional portfolio manager. Alright, and this will most probably mean that you change your paradigm, that you start thinking a bit differently about the intraday forex market and the way you approach it. So if you're ready, let's move ahead. Okay, now what you will learn in this particular training class, it's only a few minutes long, so don't worry, you can definitely just leave everything there, make yourself a cup of coffee and listen to what I have to say here. Alright, now first of all, you will learn how to define the absolute measurement of risk. Alright, and actually calculate the absolute measurement of risk. We refer to this as the beta of your portfolio, or the standard deviation, which is the systematic risk, the risk that you cannot remove from your portfolio. Alright, you'll learn how to calculate it, and then you will understand how much you should expose on a single trade, and then we'll also explain a few ways to minimize your drawdown. Alright, there we go. So how do I measure risk? Now first of all, this particular training course has been developed for the forex day trader, the intraday trader. We have to understand that we are speculating and not investing. Okay. Now the most baffling phenomenon that I've seen as a lecturer is the fact that many FX traders don't even know how to calculate how much to expose on a single trade. Alright, this is very interesting. Now this is due to the fact that 99% of traders calculate risk based on every single trade. And I believe, even though it's not necessarily wrong, I believe it's not the right way to approach your trading, due to the fact that you are not an investor. Okay, you are speculating on an intraday market here. And the reason why this is wrong, in my humble opinion, is as a day trader you are speculating, like I said, and you're not investing. Now as a speculator you should accept higher returns for higher risk, or even an uncertain return, which is most of the time the case in the forex market. Now why an uncertain return? Now you need to understand that the market is not predictable, and therefore the outcome is uncertain in every trade. I mean, if the market was predictable, then everyone would have made money and everyone would have been trading. Nothing is predictable. Okay, you can determine the direction of highest probability, but you cannot predict anything. You don't have a crystal ball. So forget about focusing on a single trade, and rather focus on calculating the risk of all your trades for a month and compare it to your monthly yield or return. And this all starts with a drawdown. So basically, instead of calculating the risk on a single trade, rather calculate the risk on all your trades for a month. And this is how we would do it. And of course we would do this with a drawdown, which is my way of referring to the beta or the standard deviation of the portfolio. Alright, this is known as your drawdown. Now drawdown is the amount of equity your trading account moves below your starting capital value for a given month. Look at this equity curve here. Alright, we can see that the growth for this month was $2,000, or 2%. But at a single or at a stage during this particular trading month, the account was actually below the starting capital value with $500. Alright, so we would refer then that the drawdown is $500 here. Okay, let's have a closer look here. Now let's assume the trading capital is $100,000. Alright, according to this previous slide now. And all trades have been executed using one standard lot. Then we can see on that graph that the growth, like I explained earlier, is 2% or $2,000, and the drawdown is 0.5% or $500. Now this means, even though I made 2% growth for the month, at a certain stage during the month my account was down to $500 or 0.5%. Now regardless of initial risk, if I calculate my drawdown, I can identify if I expose too much or too little. And this is what you want to do. Now in this case I'm willing to accept a 1% drawdown, So therefore, if I risk now 2% on a given trade, which means I effectively trade with 2 standard lots, my drawdown will increase to 1%, but all of a sudden my profits will increase to 4%. Okay, so once again, drawdown is the absolute measurement of risk, and if you can find a way to minimize your drawdown, you can actually expose more for the same amount of risk, but at the end of the day, make more money. Right, now every portfolio manager must calculate the standard deviation of his portfolio, or the beta, to know how much to expose when investing. Now you as a day trader should also calculate your beta to know how much to expose on a single trade. Now I refer to my beta as the drawdown benchmark. Now the drawdown benchmark is calculated over a period of 3 months. Now let's calculate the drawdown benchmark on the next slide. Alright, and I hope you're ready to learn something new here, or just look at your trading from a different perspective. Now look at that. That slide shows you a track record for a given trading month. Here on the right hand side is the equity curve. Remember, this is just an Excel sheet. If you don't know how to compile something like this, then I'll make available this particular Excel sheet. You can just add your trades and it will calculate your drawdown for you. Nevertheless, look at this. This is a whole bunch of trades for a particular trading month. We can see here the drawdown was 0.64%, or $640, and the growth was $5,350, or 5.35%. Alright, so even though I made 5.35% for this particular trading month, I must know that I had a drawdown of 0.64%, or $640. Alright, now let's have a look at month 2. Month 2, I had a growth of 1.54%, or $1,539. Look at that. Okay, but look at this. During this particular trading month, I actually went below the starting value of my capital, or the starting value of my equity, with $770. So therefore the drawdown is $770, or 0.77%. Let's look at month 3. Also a bunch of trades. Also had a growth there. The growth was 2.8%, or $2,830, and the drawdown here was 1.3%, or $1,336. Alright, so now I've got 3 months of data. Now I can go and have a closer look. Alright, now what's my drawdown? Month 1, 0.64%. Month 2, 0.77%. And month 3, 1.3%. Now within this trading period, the highest drawdown was 1.3%. So therefore my benchmark drawdown is 1.3%. Now mentally I'm prepared to accept a drawdown of 3%. So therefore I can now afford to risk 2% on a given trade and still have a drawdown below the 3% threshold, which will be 2.6. But suddenly my profits will also increase twofold. And what's my profits? Look at this. Month 1 I had a growth of 5.35%. Month 2 I had a growth there of 1.54%. And month 3 I had a growth of 2.8%. Now if I add this all together and divide it by 3, I'll get to my average growth, which of course is 3.23%. So now that I can expose 2% on every trade, my average growth will increase to almost 6.5% a month. So guys, therefore the lower the drawdown, or the beta, or the standard deviation, whatever you want to call it, the more you can make. Okay, and this is the first essential part of trading profitable time after time, consistently making profits. And it all starts with your drawdown. Alright, let's move forward. Now, if you know your drawdown, you will know how much to expose and how much to expect. Now you can find a way to minimize your drawdown so that you can expose more for practically the same amount of risk and grow from here. Now here's an example. Let's say you're trading with a strategy that yields 1% growth per month, but you also have a 1% drawdown. Okay. Now imagine you can find a way to lower the drawdown to 0.1%, make that 10 times less. Now this means you can now expose 10 times more for the same amount of risk, as your drawdown will remain at 1%, but all of a sudden your growth will multiply by 10. Okay, which is then 10%. Alright, so how can I make my drawdown smaller? Of course, trade in the direction of the highest probability, trade in the direction of the trend. Find yourself a context. Start it weekly or daily, 4 hour. Work yourself to the lower time frame so that you can trade in the direction of the trend, or trade in the direction of the overall consensus of people out there. Never trade against the direction of the market. Okay. This will mean also you should stay disciplined in your approach and follow your trading system blindly, especially if you believe in that. Okay. You can take any entry system and execute the system only in the direction of the highest probability, and you will see that the drawdown view system may decrease. Alright, so don't waste time searching for the holy grail entry system. I mean, there's plenty out there. Rather take your existing system and make it your holy grail by finding a way to decrease your drawdown. Alright, there are many ways out there. You're more than welcome to contact me and we can take it further. But personally, I use a context. I don't really have a trading system. Well, I have a trading system, but I don't only have a trading system. I have a context. I determine the direction of highest probability. Then I execute my trading system within that direction of highest probability to limit my losses, keep the drawdown smaller, and of course make more money at the end of the day. Alright, I hope you guys found this informative, and good luck with your trading. Thanks.